In today's complex financial world, investors are constantly searching for reliable stores of value. The year 2026 has brought its own unique set of economic challenges, from persistent inflation concerns to geopolitical tensions that ripple across global markets. This environment has reignited an important debate. What is the best asset to protect wealth? For centuries, gold has been the undisputed champion. It is a physical, time-tested asset that has preserved purchasing power through empires rising and falling. Now a new contender has entered the ring. Bitcoin, often called digital gold, presents a modern alternative. It offers a different set of properties for a world that is becoming increasingly digital and interconnected. The core of this debate revolves around what we value in a safe haven asset. Is it history and physical tangibility, or is it digital scarcity and portability? Both gold and Bitcoin are considered hard assets because they cannot be created out of thin air by a government or central bank. This makes them fundamentally different from fiat currencies like the US dollar or the euro, which can be printed in unlimited quantities. As we saw during the inflationary pressures of the early 2020s, currency debasement is a real and present danger to savers. The search for an asset that can hold its value over the long term is more critical than ever, leading investors to carefully weigh the ancient appeal of gold against the innovative promise of Bitcoin. This discussion is not merely academic, it has real-world implications for every investor trying to build a resilient portfolio. The financial landscape has shifted dramatically. Interest rates, once near zero, have found a new, higher baseline, changing the calculus for all asset classes. Furthermore, the global supply chain disruptions of recent years have reminded us of the fragility of our interconnected systems. These events force us to question traditional investment strategies. Understanding the distinct roles that both gold and Bitcoin can play is essential for navigating this new era. Each asset offers protection against different types of risks, making their comparison a vital exercise for financial preparedness. As we move through 2026, the behavior of large institutions and individual investors provides valuable clues. We are seeing a clear divergence in strategy. Central banks continue to add to their gold reserves at a historic pace, signaling their trust in its traditional role as a monetary anchor. At the same time, a new generation of investors, along with some forward-thinking funds, are allocating a portion of their capital to Bitcoin. They see its potential as a decentralized global asset for the digital age. This split in opinion highlights that the ultimate showdown may not have a single winner. Instead, it reveals a growing understanding that different assets are needed to solve different problems in a changing world. Gold's role as a store of value is unparalleled in human history. For thousands of years, it has been a symbol of wealth and a medium of exchange. Its physical properties, it is rare, durable, and doesn't corrode, made it the ideal monetary metal. This long history has embedded gold into our collective financial consciousness. Central banks, the most conservative financial institutions in the world, understand this legacy better than anyone. They hold gold not for speculative gains, but for stability and trust. When geopolitical crises flare up, as they did during the tensions of late 2025, central banks often accelerate their gold purchases. This behavior underscores their belief that gold is the ultimate neutral reserve asset in a multipolar world. The performance of gold during recent periods of financial stress further solidifies its reputation. When equity markets became volatile in early 2026 due to fears of a global economic slowdown, gold held its ground, demonstrating its low correlation to other financial assets. Investors flock to it as a hedge against uncertainty, just as they have for generations. This reliability is gold's greatest strength. It does not promise explosive growth like a tech stock, but it offers a promise of capital preservation. Central banks in emerging markets have been particularly active buyers, seeking to diversify their reserves away from the US dollar and insulate their economies from foreign policy pressures. Their actions speak volumes about gold's enduring role. The preference for gold by official institutions comes down to its tangibility and lack of counterparty risk. A gold bar held in a vault is a direct physical claim to wealth. It does not depend on a computer network or a complex legal contract to have value. After the global financial system faced several near misses over the past decade, the appeal of an asset that exists entirely outside of that system has grown stronger. Gold is liquid, universally recognized, and can be settled physically between nations without relying on intermediaries that could be subject to sanctions or political influence. For a central bank tasked with ensuring national financial security, these features are not just desirable, they are essential. Looking back at the market turmoil of the past couple of years, gold has consistently proven its worth. The inflation spike that began earlier in the decade eroded the real value of cash savings, pushing many to reconsider hard assets. While Bitcoin also attracted attention, gold's lower volatility made it a more comfortable choice for conservative investors and large institutions. The sustained demand from central banks, particularly from countries in Asia and the Middle East, provided a strong floor for its price throughout 2025. This institutional support is a key differentiator from Bitcoin and reinforces gold's status as the bedrock of the global monetary system, a reliable anchor in even the most turbulent economic seas. Bitcoin introduces a completely new paradigm for a store of value asset. Its primary innovation is digital scarcity, an idea that was once thought impossible. The Bitcoin protocol dictates that there will only ever be 21 million coins created. This supply cap is enforced by a decentralized network of computers and cannot be changed by any single person, company, or government. This makes Bitcoin a provably finite asset in a world of infinite money printing. For investors concerned about long-term currency debasement, this feature is incredibly powerful. Unlike gold, whose total supply is unknown and increases by about 1 to 2% each year through mining, Bitcoin's supply schedule is transparent and predictable down to the last coin. Another of Bitcoin's defining features is its digital nature. This allows it to be sent anywhere in the world, at any time, without needing a traditional bank or financial intermediary. All you need is an internet connection. This makes it a highly portable and censorship-resistant form of wealth. For people living under authoritarian regimes or in countries with unstable financial systems, Bitcoin offers a way to protect their savings and move them across borders. Gold is also portable, but moving large amounts physically is slow, expensive, and risky. Bitcoin's ability to transfer millions of dollars of value with a simple digital transaction represents a monumental leap forward in asset mobility. However, this digital nature also comes with its own set of risks, which have been on full display recently. Bitcoin's price remains highly volatile. While it saw a significant run-up in late 2025 as some institutional investors diversified into digital assets, it also experienced sharp corrections that tested the conviction of holders. This volatility makes it a difficult asset for risk-averse institutions like central banks to adopt. Furthermore, the regulatory landscape is still evolving. While some countries have embraced Bitcoin, others remain wary, creating a patchwork of rules that adds a layer of uncertainty for global investors. The lack of widespread central bank adoption remains a major hurdle to its acceptance as a true global reserve asset. Despite these challenges, Bitcoin's appeal continues to grow, particularly among younger investors and tech-focused institutions. They are comfortable with its digital native characteristics and see its volatility as the price of admission for an asset with massive asymmetric upside potential. The approval of several spot Bitcoin ETFs in major markets over the past couple of years has made it easier than ever for mainstream investors to gain exposure. This increasing financialization, combined with its fixed supply, has created a compelling dynamic. As demand from new institutional and retail buyers grew throughout 2025 and into 2026, the price has shown strength, reinforcing the argument that Bitcoin has carved out a permanent niche in the global financial system. The debate between Bitcoin and gold is often framed as a battle where one must replace the other. However, a more productive approach is to see them as complementary assets that protect against different risks. They do not have to be competitors. Instead, they can coexist within a well-diversified investment strategy. Gold is the ultimate hedge against systemic financial collapse, geopolitical instability, and a loss of faith in the traditional banking system. Its value is anchored in thousands of years of history, and its continued use by central banks. It is the asset you want to own when you fear the entire system might break, offering a low volatility anchor for a portfolio during times of crisis. Bitcoin, on the other hand, serves a different purpose. It is a hedge against currency debasement and financial censorship in an increasingly digital world. Its strength lies in its decentralized, rule-based monetary policy and its unparalleled portability. It represents a bet on the continuation of technological progress and the growing importance of digital networks. An allocation to Bitcoin is an acknowledgement that the future of money might look very different from its past. Its high volatility means it acts more like a high-growth tech investment or venture capital play, but one with the properties of a hard asset. holding it offers exposure to a completely different set of potential future outcomes than holding gold. A truly balanced portfolio for the challenges of 2026 and beyond should therefore consider including both. An investor might hold gold to protect against a sudden crisis or a breakdown in global trade, while holding Bitcoin as a long-term savings technology and a hedge against the slow, steady erosion of fiat currency values. This approach allows an investor to be prepared for multiple scenarios. If the world experiences a major kinetic conflict or a grid-down event, the physical nature of gold would be invaluable. If the world continues on its digital trajectory, with ever-expanding government surveillance and monetary expansion, Bitcoin's censorship-resistant and scarce properties will become increasingly vital. Ultimately, the choice is not about picking a winner in the showdown between old money and new. It is about understanding the unique strengths and weaknesses of each asset. Gold offers stability and a deep historical precedent. Bitcoin offers innovation, digital scarcity, and asymmetric upside potential. By combining the ancient store of value with the modern one, investors can build a more robust and resilient financial foundation. They can protect their wealth not only from the known risks of the past, but also from the unknown challenges of the future. In this uncertain world, owning both gold and Bitcoin may be the most prudent strategy of all.